Hi everybody, welcome back to the New York Stock Exchange. I'm Dave Vellante and welcome to our Mixture of Experts series, theCUBE plus NYSE Wired. Ivana Delevska is here. She's the CIO and founder of Spear Invest. Good to see you again. Thanks so much for coming in.
Thanks for having me, Dave.
Yeah, you bet. Well, things are good. I'm looking at the fund performance. You're up, wow, just unbelievable, 88% year to date and for the full year, because you started in December, I think, right? And wow, I mean, just up and to the right, amazing. So, tell me, what's the big thesis these days? What are you betting on?
Well, David, the big thing that we're seeing here as we look into the second half of this year is that we think there's going to be a new wave of investments on the data infrastructure side. That's been where we're doubling down on, because basically the prior generation of chips, Hopper, was going into existing infrastructure, and as we look further, Blackwell and the Blackwell systems, which are going to ramp in second half, all those are going to go into brand new data centers. So we've been looking for ways to leverage that beyond the chip side. So looking at networking, looking at power generation, those have been pretty solid risk rewards, especially as they sold off on the tariff risk. Some of these companies, like the US power generators, they're not really negatively affected by tariffs, right? So those were very attractive entry points to get into those names, and that's when we double down on the data center trade.
Okay, so before we come back into the names, I want to ask you, I mean, it feels like a one-lane highway that's getting pretty crowded. You know, it's really the CapEx story from the hyperscalers. Does that worry you? I heard a stat the other day that the return on invested capital for these hyperscalers is actually still really good. But my question was, well, what's the return on invested capital for the AI piece of it? And do you have any thoughts on that and insight? Are you concerned about sort of this running on one cylinder?
Well, 100%, that's what we're watching very closely. I think on the hyperscaler side, I don't think the returns are going to be as good as in the prior cycle. There is a lot more competition, and even though they're very good right now, as we look 10 years out, right, everybody's going to have access to this technology, right? So I think returns are not going to be as strong on the hyperscaler side. So this is why we don't own many of the hyperscalers. Some are building up on top of the infrastructure. So like, for example, somebody like Google, they may be able to monetize what they're building on top, but the cloud business itself, while it's growing pretty rapidly right now, I think at some point will tail off, and I don't think the returns will match the prior cycle.
Well, it's interesting because they all said they're supply constrained, but your play is, great, they're supply constrained, that means the demand is there, that's a good check, and they're going to be purchasing GPUs from NVIDIA, networking from Arista, et cetera. I mean, so is that part of your thesis?
Absolutely. So basically you want to invest right there where the value is in the value chain, right? So if they're supply constrained, you want to invest in how you're going to be able to add supply. And if you look at the returns on that side, they're fantastic, right? So somebody like Arista or somebody like NVIDIA, they don't need to invest $80 billion in CapEx, right? They've already made the investments, they've made the R&D, so you are going to see significant returns as you look forward as they rake in these revenues.
So, I know you're not investing in the hyperscalers, but as an investor, I mean, when you see the type of capital that they're spending there, you think they're missing something, that the ultimate prize is maybe not as big? Because if it is as big as they think it is, then maybe you're missing an opportunity. How do you think about that?
Well, I think we analyze it pretty closely, and it's all about return on invested capital, right? Yeah. So returns are going to be good. Like, they're not going to be bad. They're just not going to match what they were in the past, where you had just AWS, right? And then Microsoft entered, and then Google was third. Now you're going to have a lot more players over the cycle. So I think the returns are going to be okay. They're just not going to be what they used to be before.
Interesting.
I think that the value will be added in whoever builds something on top, right? So if Microsoft can leverage their customer base and build a tool like a Copilot that gains broad adoption and they can monetize it, that would be very interesting. AWS, that's why you see it struggle a little, right? Because they're not adding CapEx as fast as the rest of the players. They're a little more capacity constrained. They're working internally, but it's a bit risky if those efforts will pan out.
Yeah, and it's hard to, I mean, we kind of squint through the AWS numbers. I think the last quarter was 30 billion in CapEx, maybe 25 of that goes to AWS, but they're all supply constrained. When you say they'll face more competition, do you mean from the likes of like a CoreWeave and the neoclouds? or maybe even the Dells and the Supermicros and the on-prem crowd, the HPEs. Is that how you see it?
All of the above, all of the above. I think there's new entrants. There's also companies like Cloudflare that are playing in a different angle. So I think the way that the lay of the land will evolve is going to be much less centered onto one platform like an AWS. I think it's going to be much broader. So it's really going to go where the available capacities, but really the bottleneck in available capacity is NVIDIA right now, right? So whoever they sell to, they're the one that can capture the most value.
What do you make of the news today that NVIDIA and AMD are going to basically pay a VIG, it looks like, to the US government in order to secure their China sales? I mean, I guess that's a positive. What's your reaction to that?
Well, I think it's a positive, even though like at the face value, it's a negative, right, where they're paying 15%, it's better than not selling anything, right? So to the extent that they're allowed to sell, that the incentives are aligned, right? So the US government now does have more incentive to allow them to keep upgrading the technology in the chips that they're selling, right? Because at some point, the H20s are not going to cut it, right? So they're going to have to, even though don't match maybe the Blackwell systems, right, they will have to improve over time. So to the extent that they are allowed to keep up the innovation, they can price for the 15% tariff.
It's almost like the Trump administration is saying, look, if it's that important that Chinese developers are developing on the full stack, then great. Then pay the price.
Why don't I get a cut?
And you're making plenty of money, right?
Exactly.
This is kind of crazy. Okay, so Astera Labs is your number one holding. Why? What do you like about that stock?
So we sized it up on this downturn, right? As I mentioned, I think a lot of people panicked out of these names thinking that the data investment cycle is over, AI is over, right? As we saw like the impact from tariffs, I think a lot of people panicked out of the sector. So there were a lot of dislocations created in companies like Astera. Arista also got hit pretty hard, even though their numbers, they continue to keep surprising to the upside in terms of fundamentals. So what we like about Astera Labs in particular here is that they keep launching new products that have multi-billion-dollar TAMs, right? So the first product that they launched was these retimers, and they have almost 100% market share there. So like people are concerned, oh, are they going to lose share? Now they're launching another new product, Scorpio, which is yet another multi-billion-dollar opportunity. So as those ramp, that's going to be their biggest product according to the company going forward. So there's a lot of these new networking products that weren't even used before, and that's what they're really innovating and introducing.
And you got out of AMD and back in, or maybe you reduced your
That's right, we got out of AMD
Explain
for
that
a while.
logic.
So basically what ended up happening with AMD, when they introduced their first GPU to compete with NVIDIA, there was a lot of interest, and they got to over $10 billion in revenues or commitments from customers. However, when customers kept trying the products, NVIDIA remained superior. So they weren't really able to build on that momentum. I think as we look forward, customers are getting more and more familiar with the AMD platform, because the difference is with NVIDIA, you have CUDA, right? So you can build right on top. With AMD, you need to do quite a lot of in-house heavy lifting to be able to use the AMD chip. So we're hearing that customers are now getting more familiar with that, so we think that revenues are going to be able to scale. I think they're not going to be able to, it's not one of the situations where they're going to take the crown from NVIDIA, so we still like NVIDIA significantly more, but I think there is an opportunity here as the market maybe doesn't appreciate that their product is equally good, it's just a little harder to use.
Yeah, my thinking is they may have an angle with inference, especially they have the larger high bandwidth memories, and they'll get there, whatever, 10, 15%. It's almost like, they took on Intel, they were a nice, a complement to Intel, then Intel stumbled, so that they've killed it in x86. I don't see NVIDIA stumbling in a similar way. I mean,
that's right.
But they'll get their piece of
exactly
the pie.
Of the pie. So I think the big picture here, Dave, like that I think people are missing is that the pie is really growing rapidly. So you hear a lot like, oh, is NVIDIA gonna capture all the networking pie and doing their in-house stuff, or are they gonna capture other parts of the value chain? They are gonna capture and grow, but the pie is growing even faster. So there's gonna be plenty of space for companies like Arista and even the custom chips.
And you're in Marvell. Now, they supply AWS to a certain extent, right? Why do you like Marvell? Is it because of their hyperscale connection, or is it more broad-based than that?
So we like both the networking side and the custom chips. I think the thesis last year was custom chips, and those have disappointed, which is why you see the stock coming under pressure. But I think people don't appreciate that their networking side is also very strong. So as you look forward, the stock is trading lower than where it was during the prior cycle. Right, so even though you have this AI boom. So I think it's a pretty decent risk reward here as an entry point. So we've maintained our position there and haven't really changed much over the downturn.
You put out, I want to talk about networking. You put out a great tweet talking about AI data center networking. I remember interviewing Jayshree Ullal in 2012, and she was explaining how traffic traditionally was north-south in the hierarchical networks, and it was moving to east-west, and they were in a really good position to do that. Your point in your tweet was now we're tapping both scale up and scale out. Explain your thesis there.
So that's exactly right. So I think when people hear about NVIDIA entering the market, they will be more on the scale up side, right? And the point is that there is a much broader opportunity. So NVIDIA is not really going to be doing anything on the scale outside, and this is a market that could be very attractive for Arista. So it's not only that you need to improve the connections inside the chip, you also need to connect multiple chips in an efficient way, and that's really is where a lot of the value is coming on the performance side, because the chip itself, we've kind of perfected it in a way, right? So a lot of it is going to come from how multiple chips are getting connected to each other. And if you see even with Blackwell, right, Blackwell is almost like two hoppers connected together in an efficient way. So I think that's going to be kind of the story of the development on the chip side.
You mean like the NVLink 72 is how, with the link between them, that's NVIDIA's secret sauce. But won't they be connecting horizontally with, say, Ethernet or Ultra Ethernet? And they don't own that proprietary advantage that they have with InfiniBand, but they'll still sell their software and their GPUs.
That's right, but I think the broader point, exactly, that's why we like NVIDIA. I think there is a lot of market share to be captured in that space, but to my prior point, the market is growing, right? So that's really how companies like Arista are able to surprise to the upside as well.
So power, everybody talks about power being the big constraint. You own a bunch of companies in that space. Not just Constellation, but several other names. Give us your lowdown on energy.
So on the energy side, the two main ways we have exposure here is on the equipment side and the power generation side. The power generation side is a lot of these companies are going to have to sign proprietary deals to supply power to this brand new data center. So as I mentioned, the brand new data centers is really the crux of the thesis here. So power gen companies will benefit that way. So Constellation is an example. They operate the largest nuclear fleet in the US. Vistra is another example. So those are on the power generation side. Then you have the power equipment side, and that's even better risk reward, because no matter who gets selected to provide power to a certain project, the equipment will likely come from either GE or Siemens. So it's a duopoly there where they not only make money on the new equipment, but they also make money on the aftermarket. And interestingly, this market has been in a significant downturn. Margins, there is a pretty significant opportunity there. They've gone from like high teens to low 20s all the way down to zero, right? So now they're coming back up to mid-single, high single digits, but we think ultimately they're going to go back to the 20s. So a lot of the theses are company specific, so we're trying to find like which companies on the power side are the ones that will deliver outsized returns, but the broad theme is there as well.
How much of a blocker is just regulatory constraints? How much is the administration doing, in your view, to remove those, and what does it tell you about your investment thesis?
Well, that's actually been a relatively positive with the new administration. It does seem like they're working hard on removing some of the bottlenecks in bringing new generation. There were a few large nuclear projects announced that when we saw them, we're like, no way they're coming on that timeline, even as positive, even as shareholders of the stocks, right? But it does seem like they're checking the milestones. So it's been a positive surprise that they're actually able to deliver on what they're saying. And we're not even assuming that they will be able to come that quickly, but it has been a positive surprise.
And I want to double click on something you said earlier. There's a bunch of new data center capacity going. And so as it pertains to Blackwell, I want to understand what you said and put a finer point on it. those existing data centers, the hyperscalers, et cetera, they're going to get Blackwells, they're in line to get them. The neoclouds are going to get them, and you're saying there's all this new capacity coming online. So what's your base case for how long we remain supply constrained?
So I think we're going to remain supply constrained for a while, mostly because of the way the demand is ramping. So I think people are adding capacity as fast as they can, but the demand side is ramping even quicker. And a lot of it this year in this first leg is coming from...
I warned you.
Yes.
Okay, so you hear the bell, the exchange is closing, you're here at the options exchange. All right, there we go.
Hopefully we made some money.
Yeah, that's right. So I see some green on the options board. So, okay, so you were saying that we're going to remain supply constrained for a while. What's a while?
So a lot of it, so on the supply side or on the demand side, the big driver right now is these AI agents, right? So they're just getting introduced, and as those ramp, you're going to see pretty significant increase in inference demand. So I think that Blackwell is going to remain sold out until the next generation of chips comes to market, and then the upgrade of Blackwell is going to be a significantly simpler architecture. Yeah, exactly. It's going to be significantly simpler to transition. So I think it's going to be a pretty significant ramp on the capacity side. But the real question here is the demand, and that's what we're tracking closely, and that's ramping really well with these AI agents.
Yeah, I was just doing some work with George Gilbert, and he laid out this sort of 3 eras of agents. Era 1 was sort of the consumer agents, ChatGPT. Era 2 was coding agents. Anthropic and Cursor were the best example, and then Era 3 is these enterprise agents, which we can maybe get to. Interesting. First of all, what did you think of GPT-5? Have you played with it much?
Yeah, I mean, a lot of it is pretty significant improvements over the prior versions. I think you're going to see a lot of tools being built on these models, specifically on, I think we're most excited about the enterprise agent side. So I think the consumer side is going to continue to run, but really, as you go forward, I think the enterprise is really going to be where the market really opens up to a very wide
yeah, I mean, the word is, let's see, OpenAI's valuation is now up to what, $500 billion? Is that what we're hearing?
Yep.
And then yet, when you look at how fast, first of all, a lot of people are sort of poo-pooing GPT-5, saying, well, it's okay. At the same time, my understanding is that Cursor's switching from Anthropic to OpenAI. Have you heard that? I heard that today. Mm-hmm. So that's sort of an interesting
data
indication.
point.
The coders are telling me that GPT-5 is actually really good at coding, which was one of their intents. They're saying they're throwing all their GPT-4 code into GPT-5 and saying, fix this, and it does it very quickly and very well. So it's going to be interesting to see how that plays out. As it pertains, one other point, actually, and this is nuanced, because you sort of said earlier, maybe that's why AWS is struggling a little bit at 17.5% growth when Microsoft's growing at 39%. But they kind of have a GPT tiger by the tail. I mean, a lot of their Azure is coming from ChatGPT inference. Probably about half of OpenAI's COGS go to Azure.
Yep.
So it's very narrow. The other thing is, I don't know if you caught this, but Microsoft changed the definitions of Azure, and they timed it perfectly, and then they announced this past quarter, Azure's $75 billion. That's after they changed the definition. So they're brilliant. They have the benefit from a marketing and optics standpoint of high growth rates, and they announced a big number.
Yep.
So they kind of out-marketed AWS there. And so we'll see, but they have a GPT tiger by the tail is very narrow, but maybe gives them time to expand. Any thoughts on that?
Well, I think they have a lot of things going for them, right? Even with their own chips, I think eventually they will be able to crack the code and introduce this and be able to leverage them for the customers that are willing to use them. So they're still in the lead in terms of market share, right? And whether they're able to continue to grow that is going to be the big question, and maintain the leadership position. But it's really going to come down to whether their custom chip is a big success or not.
Which leads me to, so Microsoft's, my understanding is their non-cloud cloud business, their on-prem business and the hybrid business is actually doing quite well, and they probably have a better story than anybody. So that gets me to the enterprise. So a couple things. Actually, before we get there, I want to ask you about security, because it's like you're keeping your toe in the water with Zscaler, CrowdStrike, and Palo Alto Networks. So it's not like you don't like them, they've run up quite nicely. So am I correct, you've scaled down your positions there a little bit, but you're holding on to them, right? What's your thinking
Absolutely.
there?
So basically, cybersecurity performed really well in the first half of this year when all of these other stocks were getting crushed, right? Because they weren't as exposed to tariff risks and they were actually benefiting from uncertainty. So Zscaler, CrowdStrike, all of those stocks performed really well. At this point in time, data center was a lot more attractive, right? So in terms of adding to positions, we continuously try to find the better risk reward. So at some point, data center names like Arista and Astera Labs were so beaten up that the reward was significantly higher. So that's why we took some profit on the cyber stocks and shifted on to data center. The cyber stocks still look very attractive, especially there's been a little bit of a recent pullback after the Fortinet results and after the Palo Alto deal got announced. I don't think the deal is a bad deal. I think it's going to ultimately end up being a pretty solid deal. And
I like that deal.
Exactly, and the stock has gotten killed on that. So I think there's going to be some interesting opportunities as we get into the second half, and especially if prices get reset a little lower, so the upside will be a little bit larger. I think the risk for these stocks is pretty limited, so that's the attractive part, that they're usually a very good risk reward because you're getting decent returns, but you're not really taking all that much risk.
I mean, if you're Nikesh Arora, and you've got $115 billion market cap, it's got what, $9 or $10 billion in revenue, you've got to expand your TAM, and if you're pushing platformization, and you have a big gap in endpoint, CyberArk is, identity to CyberArk is a great, option there, right? And
absolutely.
now you're taking on Okta.
Absolutely, and they have, even though they haven't done a large deal in the past, they have done quite significant progress with them, like smaller M&A. So they've really integrated their acquisitions very well, and I think they're one of the better M&A playbooks in the cybersecurity space, where they've been able to show and demonstrate growth. So now that the company is a larger market cap, it is just natural that the deal sizes will become a little larger.
And CrowdStrike is probably still rich, even though people were pairing their, taking some profits, but what's your take on CrowdStrike?
Well, CrowdStrike is really unique in that Palo Alto is a bit of a patched up solutions, right? Where they're going the other way around, where they're like, hey, everything we have is like kind of developed from scratch here. So it's a pretty solid platform. It is much more expensive. So that's always the pushback on the stock, is on the valuation side. But as a platform, I think they're doing a really good job. They managed the incident that they had pretty well. So I think they were able to recover from that. And I think it's going to look even more interesting as they annualize the impact of that incident. So we're keeping very close eye on them, Palo Alto, and Zscaler as we get into second half to see if there is an opportunity to add and resize.
Yeah, not only did they communicate fairly well, some people might disagree with that, but I feel like they acted quite responsibly. But they also, I think, brilliantly came up with this, they put their flex pricing in front of their customers and said, look, we can get you in. And now there's a renewal cycle coming in, so the discounts that they had to give, they were given some really significant discounts that they communicated to the street. And now those things are coming up, for renewal, and they're going to be getting, I think they've earned the trust, at least back, from most customers. Right?
Spot on. So I think that's going to be the interesting thing to watch, like how that ramps now that they've expanded with Flex, and how the pricing impact would be to the renewals.
So okay, so we touched on that portion of software, which leads me back to the whole enterprise agent, which you would really think that some of your SaaS companies out there are going to really thrive in that space. I mean, when we first met, I think it was 2021, you were obviously doubling down on companies like, you were buying the dip of Snowflake and Coupa and some of the other, Zscaler at the time was, I think I wrote a piece around that. Like many, you've kind of dialed down your investments in SaaS. SaaS is kind of struggling right now. What's going on from your perspective in SaaS?
Well, the big thing that's going on is that there is a divergence between who has grown to a point where they've become a platform and an essential solution versus who has stayed as a tool. I think the companies that are still more of like a one-point solution or a tool are really struggling because people are wondering whether with AI you're going to be able to come up with cheaper, faster, newer tools that are going to overtake some of the older, like now legacy, right? Like they were the hot stocks like 5-10 years ago. Now they're almost like legacy solutions. So pretty much for every one of these companies, there is a show me story, right? So whether you're a CRM, you need to prove yourself now that in the age of AI, you can leverage what you've built in the past and introduce AI agents to streamline the sales process. I think it's a huge opportunity, right? But there is also a huge risk associated with it because we haven't really seen the numbers come through on the agent side. So I think AI agents will be pretty significant. I think it's a little tough to tell who will be the winner. In the cyber stocks that we touched on, I think that's a relatively easy risk reward because who doesn't want a cybersecurity analyst for free, basically, right, as an AI agent? And it's very easy for them to implement it because cyber by nature is tons of data that is well organized. So AI agents on the cyber side, I think, are almost like guaranteed to be successful. On the sales side, I think they're definitely going to be successful, but are they going to be effective, or when do they become effective? So that's what we're watching. They're not effective as of yet. Like we use a lot of these CRM tools, and I would have expected that they would be a little bit further the development curve in terms of how useful they are to people. So I think productivity is another area that we're watching closely. That one is a little tricky because the companies won't be able to capture as much of the tool, if you will. So you really need like somebody like Microsoft that has like a very large installed base, and they can charge like $20-30 per user, but you're not really going to be able to charge like $100, $200, $300. So I think that's going to be the interesting thing on the productivity side. But those are kind of the big areas: is like sales, costs, right? That you could really improve as a company.
So let's drill into analytics a little bit, and specifically Snowflake. If I recall, you had a very large position in Snowflake. You dialed that down, and then when it ran down to below even 120, I think it was the IPO price, and then you got back in.
Yep.
You timed that well, and now you've pared your position a little further.
Exactly.
Explain your thinking there.
So for us, the way it works, Dave, is like we cover a universe of about 120 stocks, and at each given time, we only own 20 to 25 stocks, right? So every time we need to add a new position, we need to pare down another one. And each company in our universe has a risk reward. So usually what ends up happening, and this is what happened to a lot of the software stocks, the risks kind of grew and the reward was still the same, right? So didn't grow in line with the growth in risk. So they became a lot less attractive risk reward profiles than some of the other stocks. So usually the way it works is when we add a new holding, we need to pare down some of the other holdings. It doesn't mean that they're not going to be successful, right? Because the reward is still there. It's just a little bit more risky in terms of whether they will be able to execute and capture.
But as we were
share.
chatting beforehand, it's relatively straightforward to take an agent, bring it into Snowflake, and help you manage your analytics. What's actually more interesting is the SaaS companies that have access to all the process data and the business logic, the Salesforces, the SAPs, Oracle, ServiceNow is another one. They have, on the one hand, an inherent advantage in that they have access to that data. On the other hand, they're big and they've got a legacy, install base, and so they're maybe not as nimble. What are your thoughts on a company like Salesforce or even a ServiceNow?
So we don't own either of the companies,
right.
and the reason behind not owning it is that they're just not showing. ServiceNow is a little bit better than Salesforce, but they're just not showing the progress on the revenue side from AI. And I think it has to do with the fact that they've grown into larger companies. Even Google, like, we're very disappointed by the pace that they've been introducing products, right? By now, they should have had like a monopoly on Chrome browser, like AI-driven Chrome browser. Like, how do you, like, I mean, not as an investor, right? always seems easier than it is to
but that
do it.
feels like a
But
miss,
it does
yeah.
seem like a miss, right? That like this sort of tools should have already been there in the market, especially with what a big advantage they had on the AI side. They were the first ones to use the transformer model.
And Gemini in we're a Google email shop, Gmail. You'd think Gemini would be much better integrated into Gmail and a whole workspace. It's not.
It's not, right? And it's been like few years now where it's like, when is this
Let's
innovation
go.
coming? So yeah, so it's very, I feel similar about a lot of the enterprise companies. I think it must be more complicated than it seems to investors looking from the outside to be able to leverage this data. The data is there, but we haven't really seen groundbreaking solutions come to the market where like the customers are excited and the revenues are growing gangbusters.
Have you ever owned Palantir?
We've owned Palantir in the past, yeah. So basically Palantir would be like a comp to us with Cloudflare. So if we kind of want to pick one versus the other, and I think Cloudflare right now looks a little more interesting than Palantir, mostly on valuation, because valuation is a big driver for us. What happens with stocks like Palantir, ultimately with the valuation, it doesn't necessarily mean that the stock will crash. Like people think like, oh, it's this multiple, like in 2 years it's going to get cut in half. Usually the way it works is if you don't see the revenues come through, the stock will stall out. So that's our biggest worry here, that if they don't keep delivering outsized growth numbers, then all of a sudden you may not see the same sort of momentum on the share price
Look
performance.
at C3 AI. I mean, that's been, hot AI. The only thing that's AI I heard somebody say was in the name. That's it, right? I mean, it's just a big disappointment. The fortunes change quickly. But the reason I bring up Palantir, and thank you for those comments on the valuation, and I understand that. But it seems like, and it's hard to get information on them, but you see architectural diagrams and you can speak to their engineers. They have built actually a system that has a 4D map of an enterprise, the people, the places, the things, the processes or activities, and in a knowledge graph, and they're taking advantage of that process data to really drive massive productivity gains. And we talked earlier, Salesforce is moving that direction. They seem to be doing the engineering with the data cloud, but they've got such a big install base and such a legacy business, it's probably not as interesting to you.
Yeah, so interestingly on the Palantir side, I would have thought, let's say 2-3 years ago, that companies would be apprehensive with putting their data in one solution versus building it on their own. But it doesn't seem to be the case. I think people just want the problem solved. So I think, for example, comparing them to somebody like Snowflake, you should in theory be able to use Snowflake and build something similar to what Palantir is building for their customers, and in that way you control your data and how the data is being used. But it doesn't seem to be the case. It does seem like people just want, hey, here's my data, it's all like in different ERP systems, just put it somewhere and give me a solution. So I think they've done a pretty good job on that front.
I mean, our take is that the value, it really isn't in the LLMs. I mean, it's going to cost, I don't know what it costs. GPT-5 probably cost, I don't know, many billions to train, 4 or 5 billion perhaps. GPT-6 will probably be closer to 10 billion. GPT-7, it'll be closer to 30, 40 billion. I mean, I don't know.
Yeah,
maybe
and the
50
scale
billion.
and the pace that you have to upgrade, right?
Well, yeah, and you think about the pharmaceutical industry. I don't know if you've ever invested in pharma, but they have 10-year, patent protection.
Yep.
These guys have like 6 months.
3 months, yeah, exactly.
3 months, right before DeepSeek comes out with an open source model. And so the point being, the value's not in the underlying LLM, it's the agent on top of it. And when you get into the enterprise, if you don't have that 4D map of the enterprise, that digital twin, if you will, of the enterprise, and your data really in one place, to your earlier point, it won't work. You've just got, you can do collaboration like Copilot, or even Glean.
Yep.
Right? Glean does what Copilot should have been. That's nice, but it doesn't get deep into the processes and the workflows of the organization beyond that sort of collaboration and the transaction systems, and that seems to be the missing piece. So whoever can figure that out, and it seems like Palantir, has a model there, notwithstanding the valuation.
Yeah, no, I absolutely agree with that. And I think you're spot on the model side. That's the view we share. I think if I were an investor today on the private side, I would be pretty cautious about investing in some of the model companies. I think if they can build something on top of it, like Meta is doing, right, where they have the model, but they're also using a lot of it internally, and now they're like, well, maybe most of it is open source, but some of it is not. So I think if you can find a way to use the model in a proprietary way, I think that could be a value add, but just the models themselves are really going out of style in less than a year, right? So it's a pretty tough, it's
brutal
a pretty,
economics.
Yeah, pretty tough business.
Now, are you always risk on? Is that your promise to your investors? Is that you will always be fully invested? I mean, you
yes.
got no cash, really.
Yeah, no, so we're always risk on. We try not to play with the cash and time the market. What we do during downturns is we increase risk, right? So during like this pullback with tariffs, we were able to capture some of these riskier names that really got like sold off in a way that wasn't really commensurate with their fundamentals, right? So we talked about some of them. And what we also do on the risk management side is try to cut out losers or analyze who doesn't have the risk reward. So we really try to manage the risk rather than cutting it during downturns and missing out on the next leg up. So really the key is during downturns, we try to find like, will this stock be able to capture like a higher high after the dust settles, or is there a problem in the model where it's going to kind of tail off? And we try to cut those companies out. And
you get liquidity from selling existing positions and then shifting them to new positions and inflows.
Exactly.
How's that going? I mean, when we first met, I mean, you were just getting started. And I remember after our interview, people called me up and said, hey, I put a little bit of money into Spear. I'm like, great, let's see how it does. And it's done great.
Yeah, it's been growing. Part of it has been performance. The performance has been very, very strong. And then we've gotten inflows as well. So we're at about 75 million, which is a good number. But yeah, we'll hopefully with the cycle ahead of us, we'll continue to grow.
I mean, what's your North Star? You want to get huge. You obviously worked for these big institutions and had a very successful career. Congratulations on going out on your own. We love that entrepreneurship. You want to get giant? You want to keep it small and manageable? What's your goal?
Well, in terms of the capacity of the business, we invest in highly liquid stocks that really there is like the limit would be in the billions where you would hit liquidity type concern. So there is no real limit from liquidity perspective. From my personal perspective is I make a lot of my returns on my investment in the fund. So to me, it's more important that the fund performs well rather than that I grow the number of investors. So that's why you've seen a slower growth in AUM from inflows rather than performance, right? But yeah, I think over time both will come. It's just a matter of
okay, but so you're aligned with your investors, obviously, and you keep it to, what'd you say, 25?
Yeah, so that's really that is the key basically way we generate alpha, right? If you have 100 names, all of a sudden your returns will start mimicking the indices. So really the key for our strategy is to keep the numbers of names down and keep the mistakes low. So if we can have a high hit rate with decent win-loss ratios, those are metrics that we track closely. That would translate into alpha for our investors.
Well, you're an extremely competitive business, but your differentiation as you go deep into the supply chain, I've always loved your story, Ivana. Thanks so much for coming back on theCUBE.
Thank you for having me.
You bet. All right, and thank you for watching. This is Dave Vellante for theCUBE plus NYSE Wired, mixture of expert series from the New York Stock Exchange. You heard the bells. Thanks for watching. We'll see you next time.